All right, welcome to this episode of Real Estate Chat with
Robert Eid.
and John Perez. Robert,
Yes, sir.
is the real estate market hot or not?
Oh, yes and no. Yes and no. My sister, my daughter, my sister, my daughter. You probably saw that in Chinatown.
In what?
In movie Chinatown, it's the climax where Faye Dunaway is screaming and Jack Nicholson is smacking her to give a straight answer. Yes, she's my daughter. No, she's my sister. No, she's my daughter. Yes, she's my sister. And it was the father of.
We may end up editing this out. But
Yeah.
anyway, hot or not is the question. And depending on where you watch the news, watch your social media, read your newspaper, there seems to be the doom and gloom camp and the everything's going to be a-okay and prices will continue to shoot up camp.
Yes.
And so Robert shared with me, and that's what we're going to take apart first and foremost as we start our discussion on Real Estate Chat today, is this Desjardins. Desjardins is a financial institution. What kind of financial institution are they again, Robert?
Well, it started out as a credit union and grew, and then it got rationalized, and then bought the Ontario Provincial Credit Union, and then bought Safe. Now I can't remember. Big insurance company from the States that was in Canada for so long.
It's State Farm.
State Farm.
Yeah.
And so now they're a huge deal. They're the biggest mortgage lender in the province of Quebec. And like, if you like a credit union, you love a credit union because it's a provincially regulated, And somehow they were in with Meriden, which my wife has an account over there. And so it's a very big deal in a very small way because it's nowhere near the size of the big six.
And that's the interesting aspect of it, is they're a financial institution that has a direct to do with their business with mortgages. And so with their economic viewpoint, the market is hot. And so going through some of these charts and graphs, and then we're going to look at Robert's later, and then Robert will give his analysis. It looks like recent market gains look to be here to stay. So their forecast, among other things on this report, which we will link in the show notes, is that the prices will steadily go up. And this is a lot to digest. And I was reading through this late last night as Robert had shared it with me. And basically, it's a talk about supply, demand, immigration, the fact that the supply here in Canada, in Toronto, in Ontario, anywhere cannot keep up, especially in the BC and Ontario markets, because a lot of immigration is happening in these two major cities. And so their forecast well into the future is that due to the lack of supply and due to the excessive demand, due to population growth, due to immigration growth, prices will continue to shoot upwards. In fact, here's a population growth chart that you see this big, huge spike here, right? Robert, anything else that you found particularly interesting about this report that you wanted to point out?
Well, on the very first page towards the bottom, it says housing correction, ? What housing correction? And then it was once believed that there were immutable laws of housing market physics. And an immutable law is something that never changes no matter what. So this is the premise for him talking about how this time's different. And it's very interesting. Now, I'm glad you asked about what type of institution is Desjardins, because they're a mortgage lender. And anybody who's in the mortgage business does not want to have values go down because that puts their assets at risk. And as a deposit-taking institution, their whole ball of wax is based on having assets that are greater than what they have put financing against. So it's a very complicated ball of wax that they're trying to look at from a real estate standpoint. And the justification is to say that nothing wrong is going to happen in the very near future. The beyond future, of course, nobody knows, which you got to give it to them. Nobody knows what the future will bring. But as you said earlier, there's two scenarios. One is that we'll have a miracle recovery like we did after the meltdown of 2008 global financial crisis. But they did that with 0% interest rates. So they're not going to do that. And then there's the other group that says there's a big mudstorm going to come that's about to hit the fan. And when that mudstorm hits, all the rules go out the window because we've always been able to count on our currency, whether it was backed by silver or gold, or backed by really strong governments that didn't, they could always pay, bonds. So there's the question, and we can talk about Toronto in light of what this fellow is saying. What this fellow, or there's two of them, are saying is that the regular five things: surging population, tight labor market, amassed pandemic era savings. Yes, there's interest rates, and we have a shortage of housing, and they're behind schedule on building them. So these are the things that if you talk to anybody, you see anybody on TV, they all talk about the same thing. Big on the immigration, saying that this is how we're always going to have, as you said, huge demand, and we're behind on supply. So that's going to drive prices up. Now, as a simple boy from the small city of Etobicoke, I think differently. I think that there's got to be a real reason that we can explain what's happening now. And it comes down to two things. If we are 10%, 20%, 30% below the normal, which I call the 10-year average, of both sellers and buyers, why can't we hit the averages? Why are there so few buyers compared to normal? And why are there so few sellers, which is really the thing, supply, compared to normal? And if we look at those things, we get more answers than we do, because this chap here, he's got a big job to do. He's got to take all the numbers from all across Canada and all around the world and put it down into 4 or 5 pages that doesn't mess up his company's objectives of lending more money. So, but I don't care about that. I only care about what is really happening. Now, I've been wrong before. I thought we were going to all be in a terrible time now, that there'd be a glut of properties, that people would be desperate to sell because interest rates are so high, and they would start doing 0% mortgages for a second mortgage to facilitate, create a special interest in their house, or do a joint venture because the prices were so high they'd only sell a 50% interest in it to somebody else. But those things came about because when the Bank of Canada paused in January, everybody thought it was over. And so then they started saying, okay, what can we do to just get over this hump? Let's buy now, because well, that's what we can talk about. Why are so many buyers buying, and why are so many sellers selling, but not what we're normally expecting in May and June?
Well, let's look at it to basically launch point from talking about interest rates, which are also tied into inflation. By the way, so this is an extensive report. Make sure you read through it as we're commenting through it, because it does talk about, at least in Desjardins' point of view and their economics department's point of view, the perspective of why prices will continue to rise. And without a doubt, real estate goes up well over time. And they do have their forecasts in terms of, how many more times there's going to be interest rate increases. So they're anticipating at least one more interest rate increase coming July. They talk about the housing starts and how that's affecting the market. On the very last page of that report, they also talk about their forecast. So I believe in Ontario, they believe there's going to be a bit of a dip, a 5% dip in price. But you know what? Let's pull that back up again, because what's interesting to point out, and what a lot of pro real estate supporters of rising prices show, is that, when you look at the average home prices in Canada, let's not forget that there have been increases after increases after increases after increases. And to give up a dip of a 5.5%, you're pretty much just giving up 1 year or less than a year. And then there's another, now they're forecasting in 2024 an increase of 3.7 percentage prices for the average home price in Ontario. Now, does this fare well to those who think that the real estate market is not hot, which are those who are right now facing high mortgage payments due to, let's say you have a variable rate mortgage, but your monthly payment is fixed. And so now your monthly payment is being eaten up. Basically, the principal has been eaten up by the amount of interest that you're paying. This is due to the rising interest rates, and your monthly budget and what you're spending per month has grown because of inflation. And so, Robert, you shared this graph, and there's a really interesting point on here, because we seem to forget when we read a headline that says inflation has slowed. What are people forgetting when they see that, yay, wow, 3.4% is the inflation in May 2023? What did they forget about?
Well, that's this year's increment on top of last year's increment on top of the year before's increment. It's cumulative. And so if last year was 8% and this year is 3 and change, so we're talking about 11%, and the year before that was 4%, now it's 15%, and that's more like what you're experiencing at the grocery store, and what you're experiencing more of that in the gas station, because that is a tax that they put on there to try and discourage consumption of that fuel. But unfortunately, everything is in a boat or a car or a train or something that uses that fuel. So all of those prices all got jimmied up by compound effect of the increase in the fuel. So
when you look at a chart like this, Robert, like, it's great that they've illustrated this, and one would think, the public would think that, yeah, wow, inflation has dipped, but I didn't see a drop in the price of bread. I didn't see a drop in the price of what I'm paying at the grocery stores, right? But this would seem to lead you to believe that yeah, it should have been a drop.
This is the presentation, because I corrected a fella I got this first from Twitter yesterday and said, but it's cumulative. Well, doesn't anybody do a 2 or 3 years accumulate? And so he said, no, this is the Bank of Canada's mandate, is only to manage it on an annual basis. So this is the trick. We talked about anniversarying out for our house prices a few months ago. So this is the same thing, that if you can keep people's eyes focused on what you want them to think about, they'll forget about everything else. And so the rate of change, those are two different things. Is it getting bigger? Is it getting smaller relative to the trend? Are all how, I don't want to say liars figure. I don't want to say figures lie, but your choice of your starting point and the choice of your end point, if the end point is today, you haven't got a choice in that. So the starting point really dictates whether your chart justifies what you're trying to, your preconceived notion was, or whether it doesn't. And so you change your data, you change your timeline in order to make it agree with your notion, because that's the whole reason why you're putting the piece of paper out to the public. So your question about well, first of all, my question is, what is inflation? And what is inflation is a measure of the decreased buying power of the currency that we can't switch. We can only use a Canadian dollar. Everything is valued in Canadian dollar, but you can buy less with the Canadian dollar because a certain factor or a variety of factors have come to take away its buying power by driving up the price, or by ceasing to suppress the price. Apparently something's going to happen with copper soon. All these things. And, my poor little head, if I'm a consumer, I only care about, can I have enough income to cover my expenses and put a little bit away? Or how short of that am I, and what can I do to affect things so that I go back to balance? Because I'm running a little household here and I can't go negative, where some of the people that are telling us what to do can go negative because it's not their money they're talking about. So you mentioned a very important thing a while ago. The new factor this time in this credit crunch is that all the people that took the adjustable rate mortgage, variable rate, whatever you want to call it, were on the payment stays the same, but the amortization moves, so that their payment would always be the same, even if interest rates went up a little bit. Like, the whole idea of the stress test was to give insurance, so that if you took a fixed rate you would be qualified if rates went up, say 2%. Now, they did do that. We should have known that was a warning. We should have all taken fixed at the lowest point possible. But we didn't. You said we want to take the low rate, 0.1%, 0.7% for a mortgage. Wow, that's fantastic. I'll take as much as you got. So now they're adjusting. So in the past, your payment changed. It didn't this time. People were getting amortization stretched out, so that as long as their payment was covering the interest component, who cares about the principal? That's true, because who cares? As long as the values don't dive, then everybody's okay. And that's where we started before. The lender doesn't want to be any more underwater than you as a household want to be underwater, but they've got to be able to present information to whoever regulates them that their assets are still worth as much as they were when the lending took place. Like this OSFI is putting out a thing, and that's what their whole stability and integrity of the lender is, what their mandate is and what they're driving at, what they're asking people to qualify at greater levels of stringency, because they want to make sure that It's only well-qualified people instead of barely qualified people that are getting mortgages now, so that if anything goes bad, because there's indications that it might go bad, that our lending institutions won't have to amalgamate or do bad things.
So a lot of information right off the bat to digest, and you thought this was a simple discussion about what one of the financial institutions posted their report about. But let's now ask Robert, because as we're recording this is June 28th, so 2 more days until June finishes, and let's look at how all of this affects the market. Let's start with your sales forecast.
Okay, so this was done yesterday, 18 out of 22 reporting days, and we are still slightly less, depending on how you count, 12 or 20% below the averages, which means it's not bad compared to where we were a few months ago, but it's not good. Until we hit, as I said last time, until we hit the average, we can't even talk about good, because until we get to normal, we're not good. So that's saying 7,500. Okay, no, this is interesting, because we were making a big deal of when the average price, which I'm guessing at $1.2 million. And that's just a nice round number, which is just a titch up from the month before. It's only 0.3. I'm sure it went up $4,000 from month to month. And it breaks through, you made this point last time, breaks through the previous year's falling curve, and it's ahead. And, normally that's what it does. And we've had enough sales, and the sales at the higher price, that it should move the average up. It'll be more than that. It'll be 1.2 something around. So this is at least what it's going to do, but it breaks through the previous down link and gives us an idea that prices are still going up. And this is what Mr. Bartlett at Desjardins was saying, that if there's anything bad, it won't be right now. It'll be next time. And for this foreseeable future, 1 year, prices will recover from where they were and go up across Canada, which across Canada is almost seasonally adjusting the data, because there's so many variations and so many different markets within there that it's not meaningful. So
this is the market is hot camp, right? And this is significant because I believe it was in our last episode of Real Estate Chat. Make sure you click like and make sure you subscribe. The average throughout Canada, so this is based on CREA figures, the average throughout Canada was up year over year. In March for Toronto was down, or Toronto Regional Real Estate Board area, it was down. But this would play, so if Robert is correct or close in terms of his forecast, this is a significant figure, because it is a huge jump from last year's figure. Keep in mind, though, that it's easy to compare an increase in price to a dropping market and make it look good. But what's going to be important here, to Robert's point and to the Desjardins report, is that what happens throughout the rest of the year? Are we going to see stability, or are we going to see a dip? Because one of the things that the report mentioned too, or maybe this was some other place I heard it from, is that we're not feeling the effects of previous rate hikes right away. So the most recent rate hike, you're not going to feel that until months out, right? And so this is a continuous wave of effects that's about to happen. And we may not yet be at the end of it. For the market is not hot camp, there's still a chance that you might see something that, who knows. But let's look now at the school year point of view of this.
Well, this is the school year, and also with the previous year limited. So it starts in September, in this case, September 22, and goes to now. It ends in August. So we're seeing the whole year almost mimicking the regular pattern. And again, my last one is at 1.2. It will be higher than that, because prices went up last month over the previous more than 1%, I'm sure. And I think without the distraction of the huge up and the huge down, you see that prices, which is a whole different thing from sales, which is a whole different thing from what's really happening, prices have not fallen. What we don't want to see, no one wants to see, it's in nobody's best interest for nominal prices to drop. No homeowner wants their equity to be diminished. No real estate wants to see values dropping, because they said, oh, well, we're in a bad business. It's the values dropping. There's no good. And no lender wants that, because that undermines their assets. And no government wants that, because they must have really screwed up in order for that to have happened. So what do? They devalue their currency. And that is my belief. One of the reasons why we're seeing prices not collapse this year, not fade, people not panic and sell, is because this extension, did you say the lagged effect, which added the added lag because they were able to change the amortization. They didn't hit the wall of payments and I can't afford this anymore. There was accommodation was made. And many people did take longer terms, and they were qualified at 2% over. So there was some buffering. And if the poo hits the propeller around the world and in the United States, then the poo will hit the propeller in Canada, and we will see some major adjustments. But all of them are in the same game of keeping everybody happy and focusing on nice things rather than unfortunate things.
So it's in everybody's best interest, except for the real estate haters. It's in everybody's best interest for the real estate market to remain hot. Let's look at slowly inching up, and slowly but surely, we're going to end up hitting this average, I think, if this continues on.
Well,
why are we now
most of
seeing
June? It might, yeah. We're still. What does it say? -15, -10 off the 5. So it's coming there, but again, until we hit the average, we can't talk about normal yet.
All right, let's look at this future
Okay,
price.
well, this was supposed to be an example of this crazy thinking that I had, that the mortgage payments were at a stress level, and in mortgage payments at 7%, we're going to just kill the prices. And I was wrong. It didn't happen this way. Because the new factor that you identified, that there's some accommodation from lenders that never was there before. And so people aren't compelled to sell because of payment problems. And the other thing is that normally we see a great number of sellers who are selling, I call them last time sellers. They're selling the family home, they're cashing out, they're going to live on that money, but they've got to go somewhere. So if their choices are eliminated, number one, they can't go out of town because they'd have to go to like past Kingston in order to buy something reasonable to live in and still put some money in their pocket. And they don't want to go in town without paying $7,000 a month to some care facility like my mother is. And they don't really like the idea of having to apply for a mortgage if they got to go through a stress test again, because they're not making as much money as they were in the last year before that. And everything. They don't want to they don't want to get turned down by a mortgage company. And so what they do is they do nothing. And so that's why we don't have as many resale homeowners moving, because they got nowhere to go and no motivation to break out of inertia. And if you don't have a motivation to break out of inertia, that's what you do, nothing.
And that's full circle, right? So to Desjardins' report and how Robert ended off is that sellers are sitting on their property that have gone up in price. To buy something next would cost them a lot of money, not to mention the high rates that are going to affect their payments. So they sit still. It creates that inventory challenge that we have. With regards to the government, you all have seen the Toronto mayoral results. We try to stay away, at least I try to stay away from politics in these discussions. But when it comes to the red tape built around building homes and increasing the supply, it's a perpetual effect. So that's this constant inventory challenge, the lack of new or the slowness of new construction going online or housing starts. It's going to feed into the perpetual market is hot camp, because real estate prices tend to go up over time due to supply, due to demand, basic economics, inflation, and everybody's best interest for it to do so. If you like this episode, make sure you click like. If you dislike it and you're a real estate hater, that's okay too. Make sure you dislike. But overall, give us your comments. Share the good, the bad, the ugly. Share with us. And, one word comment, hot, not. Tell us what you think the real estate market is here in Toronto, in Ontario, wherever you live around the world. Great seeing you here on Real Estate Chat. Robert?
Canada Day coming up. Have a great 19-day weekend, and see you next time.
Have a good one. Bye for now.